All right, so we started the day off relatively strong. We had a pretty decent move to start, following up on a lot of what's been driving us bullishly over the last week or two. That continued until about middle of the day, and then things changed. So I'm going to break down what's been driving the strength, how it changed in the middle of the day, how that impacts what we expect, and whether or not we can expect to continue to be more bullish. Was today's selling a precursor of more to come, or was it just noise and up and down noise? So I'm going to break that down from a technical analysis basis. We're going to talk about this move, the extreme sentiments that we're seeing here, and what that means, and again in terms of whether or not we can start a good multi-month run, intermediate run here, or if it will be just a multi-week run, or if it might not even turn into that. So I'm going to break that down, and then today's trade ideas in an area that's in the cyclical area that has actually been holding up better than the other cyclical sectors. And then when things reverse course, held up better during the decline on an intraday basis today. So that gives us hope in either direction of how it can perform. We're going to talk about how we trade that. So let's go ahead and get started. Today is Wednesday, November the 18th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. Let's take a look at the S&P here with the market forecast indicator like we always do. You can see the decline that we had today getting below the previous 2 days. Still in the range of what we were last week, so it's not a huge decline. You notice that after the gap up last Monday, we traded in that range last week, and then just shifted up here so far this week until today into the upper kind of half of the range when you consider the upper half of Monday's range being that long upper shadow, and then the lower half being the gap, and then the intraday range, or the body between the open and the close. So that's we traded in the lower half for most of last week after, and then in the upper half so far the first 2 days before today, and we'll see how much of a follow through there is on that heading into the last 2 days of the week. You notice the momentum line after this big, nice, long rally that did not have any oversold momentum lines. See, this rally had quite a few oversold momentum lines. And of course, this one had a few as well. One in particular right there after a couple of down days. But really extreme momentum drop there, coming from, relatively, a pretty decent peak on the momentum line. The other thing that stands out is that near-term line dropped. It was only above 50 for 3 days. It did get up to a slightly higher high point on a closing basis, not necessarily obviously on an intraday high basis, but a slightly higher high there. But not a real strong near-term run of 7 to 12 days, which is the typical time frame. And just like that, it's dropped back down. The intermediate line's dark green because it's still above 80, so we're not too worried about the light pink shading quite yet, though on some of these other indexes, not necessarily on the Dow, although the Dow did form a bearish engulfing pattern there today. Also traded in the upper half of last week's range. You can see the NASDAQ, a little different. The NASDAQ had that big engulfing pattern on Monday, and still has been unable to really get above that 78% retracement after failing twice at those levels and rolling back down. This one's closest to getting light pink shading out of all the major indexes there. It's got the closest one to doing that. And then finally, the Russell 2000 is not very bearish at all. In fact, it actually produced a bullish pattern here, just like it did over here. So again, there's that Monday, it's trading the long upper shadow, closed above that this Monday. So a big break. It was the only one to even come close to breaking above last Monday's high, and it did it easily, and ended up producing another overbought cluster here. The last one started some weakness, a little bit of a long lower shadow, and a hanging man, hanging man pattern yesterday with a long lower shadow there, and then potentially this bearish pattern. So we'll see if this overbought cluster leads to some weakness like the last one did. there on October 23rd was when that peaked. October 23rd is right there on the S&P. So we were already relatively bearish in the S&P before the Russell peaked, and then we got the weakness across the board. So it's a bearish. It was obviously a bearish day. It's not a trend changing day, but we've talked about this idea of whether or not this breakout here is legit, and whether or not we're starting a multi-month intermediate rally. And the idea was that there's a good chance we're starting an intermediate rally that may only last a few weeks, maybe because again the small time frame, the small end of the range of the expected time frame of an intermediate run is one month, so 1 to 3 months, and so this might be just a multi-week instead of a multi-month intermediate run before things roll over, and depending upon how we follow through with today, that might not be. So it's not, again, we'd probably have to fall back below this 3,500, so last week's low point, if we're really going to be like bearish here. So don't get caught up in the up and down noise. I know a lot of people talked about how stocks tanked today, and that's just not the case. It's just noise. This is up and down noise. It's not going to be bullish until you break above last Monday's high. You're not going to be bearish until you break below last week's low either. So in between, it's just noise, up and down noise. And right now, we're just happen to be stuck kind of in the middle of that range. So don't, again, and that's a relatively wide range. The low there being at 35.11 and up here at 36.46. So you're looking at over 125 points of range there. The typical ATR right now is 61 points. So it's a couple days of ATR stuck in this range. So it's it's a relatively wide range. We could be here for a few days as the market tries to figure out whether it's got bullish. I mean, it's obviously got very strongly bullish sentiment, but whether or not it's bullish enough to sustain a move to the upside, or whether or not the bearish, whether we're too extreme in that bullish sentiment, and we need to get a little bit of a correction first. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, you don't have to click on anything. If you do like our videos though and you want to let us know, which we really appreciate, give us a click right now while you're watching. Again, that's like our feedback. That's our survey for these videos. We take a look at those every video to see what you guys are thinking, gals are thinking there. Also, while you're down there, comment. What stood out to you today in tonight's video? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other classes and things that we have over here on the right, including our Market Outlook live video. This is why I go back and review all the old Market Outlook trades. I actually still get emails from some of you viewers asking to review some of the previous trade ideas I did. And I do that in these live videos every day. I do the Market Outlook. So 3:30 Eastern time, this is where you go. You can click there on this icon, or you can come up here, click on the live trade review. All of our subscribers, our premium and our monthly subscribers plus subscribers, get access to that video. So check that out. You also get access to all of our trading rooms. Our Q&A sessions are for our premium subscribers. Also our class forums and our premium resources, those are all for our premium subscribers as well. Come down here to the bottom, click on this heart right there, opens up a new window. Hit that like button. Also, while you're down here, hit the thumbs up icon on that, opens up another new window here, and hit that like button as well. Again, the more you do that, the more it benefits us, because Twitter and Facebook will promote our content to all of our followers. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, so last week we talked about, it's a very strong bullish candle in the Hakanyashi, though the PPO is already really high, which is one of the concerns about, a good, 13, 14, 15 week intermediate rally. Those typically don't start when you're already 6% of, gap between the 50 and 200 day moving averages. So more than likely two or three. And when you look at this, very strong move, we're not getting a higher high point compared to last week. The close is very close, and depending upon how we finish the next 2 days, we might end up with a lower close. So it might not be as bullish. It's going to be unlikely for us to get a lower shadow, and that would be pretty bearish. But more than likely, worst case scenario, we end up with a lower close, and that will kind of show kind of what we see here. Not a good bullish follow through when you don't get the higher high and or a higher close. In this case, you actually did get a little bit of a lower shadow, that was smaller range, and that led to some bearishness the week after that on the previous peak that we've had. So setting up for something similar, just without the lower shadow here. You look at the 3 green arrow chart, and you notice the MACD is really kind of dropping now. We're losing some momentum. The stochastics is still well above in that reversal zone. Excuse me, not that one. But you can see, how close we are to crossing below its below its moving average. Of course, that's what gets you the red arrow on the MACD when it crosses below. You can see the MACD is rolling over and turning down here. And today's weakness, as of right now, basically just got us to the 8-day moving average. So if we bounce off of this tomorrow, then forget it, right? We're fine. It's if we break through that and we test the 17-day, which is down there at 350, that's kind of the next layer of kind of where we stop here, kind of like what we saw there, and we stayed there for a while before we broke through that and stayed down, and that's when we got more weakness below that 17-day moving average. So kind of watch that level to be kind of our next area of support. For other reasons too, if you look at the Bollinger Bands, here, you can see when we get down to 350-ish is the bottom of that little volume node right there. So there's some pretty decent volume in this area, some previous highs. If we break that, now we're looking for a move back down towards the 340 level, back to the value area, and a little bit below that where that strong level is. Of course, going to these previous lows would be where the point of control is, as well as that 23% retracement level. So we'll see if that ends up being strong support. This pre-COVID high point as well, sitting right at 340, will also kind of add to the strength of that support on any kind of pullbacks. You look at the RSI, it is back below 60. The CCI is back below -100, but not into the lower half of the range yet, so not necessarily bearish there. The DMI positive index has dropped below. The issue here with this idea of this being a new bullish intermediate run is the negative index has never dropped below 20, and that's a concern. That's what's kept this ADX down, because it stayed relatively high. So we're really not getting a good trending move yet. It's a pretty decent directional move, but not directional enough to produce a trending move, according to the ADX. And then when you look at the Ichimoku cloud, you can see we're kind of failing at this moderate strength level again as we pull back to that green line, the Tenkan line, and then look now for potentially a move down to that Kijun line, which is down towards that 340 area. The 340 being that pre-COVID high is also where the cloud is. So 350 initially, that's where the 17-day moving average is, and then a move back down to 340 if that level can't hold in the next week, and probably not by expiration. 350 maybe by expiration, 340 probably come initially afterwards, kind of like you saw those last couple expiration cycles where you were weak going into it for a few days and then weak coming out of it for a few days before we started a post-expiration move back to the upside. All right, now let's take a look at the intraday chart here. You can see the pullback occurred late, right about when they closed the New York schools. We started to get some selling. Remember, we had some gaps to fill. We did fill in this gap from Monday, early Tuesday morning. And then we filled in Tuesday's downward gap by the end of the day Tuesday. So we've been filling in these common gaps. We still have this one from last Friday that we need to fill in. That gets you down to 350. We talked about that being a level, but there's some support there. And we also talked about 340 being the pre-COVID high and some support in that area, which would also be a smidgen below that 23% retracement level that we've had our eyes on for a while. So it would be back, wouldn't be a big drop to the downside, but it would start filling in the gaps. Remember, it would fill in that gap over here from last Thursday that I've mentioned to you before, that the Qs have already filled in, right? Easily more than filled in. The Qs still have to fill in this gap from Wednesday, and then of course this one would be in play from the election Wednesday. So just kind of keep an eye on that in terms of the Qs and whether or not those end up getting filled in. Of course, we have this gap from last Friday on the Russell 2000, and then we haven't filled in any of that gap from Monday. So the Russell's got more of a volume gap here that it can fill in if it were to break this 172 level. So we'll kind of keep our eyes on that again over the next couple of days to see, if this weakness at the end of the day persists into something more that changes the short-term trend, which is again kind of where I'm leaning towards and expect something like that to happen. Another thing about today's move, again, that's why we don't get too worked up about this, is we didn't get a lot of volume, just a little bit below average, 70 million. The trading range was 5 points, so it's not like we had, a significant down day here. If I look at this first, 5 points is below the average, that brings that down. Volume is below the average, that brings that down. We still are relatively high on the ATR. We're also relatively high in the VIX, so getting back above 90%. We're not bearish on volatility yet, so we're still kind of in we're not full on risk appetite mode here. We're still kind of at that point where we can bounce off support on volatility and move higher. And today's not the day that would say this isn't a significant day for the market. Actually gapped up initially, a very, very small opening gap, though you can see that we had a down day by the end, but nothing significant there. I mean, that was more significant there on October 28th that ended that run, and we bounced off of that low point with all these bullish days, enough to bring the VIX down to where historical volatility is, kind of like what we had over here in last February, where you had a gap and not as big, but you had a gap and we came down, and then they both rallied. So that's, I don't expect that move because that was COVID, but when you close the gap, that can lead to where you both rally. In this case, it was just the implied volatility that rallied during that kind of bearish move in October. We didn't get a significant jump in historical volatility. So we'll see if that ends up being the case here, depending on upon the type of bearish moves we got. You can see after we had that really good bullish run there in October, kind of a extreme run for closing that many days consecutively. We did it again over here, but then we didn't really get strongly bearish moves until the very end. So we'll see if that ends up being the case here, where we kind of pick up gradually to where we get the biggest bearish move at the end of the move. All right, so before we look at some other charts, just to summarize that technical outlook, we've been bullish. We haven't really been buying into this bullishness. There's been a lot of extremes in sentiment. If you follow me on Twitter, I shared out today's a chart that showed, just how extreme, the bullish sentiment is from a standpoint of how many stocks are closing above the 200-day moving average. It was close to 90% here. So it's a pretty significant extreme. In the past, it's led to some weakness in the short term. I expect that will be the case again here. I do think that we'll get a good intermediate run eventually. I prefer not to start now because it won't last very long if it starts now. But if we can get, more of an exhale, if we can get more of a intermediate pullback to finish what we started in early September, we get more stocks, that aren't so high above their 200-day moving average, maybe down towards that 60% range, then would feel very confident about a good multi-month intermediate run starting out, whether it's by the end of December or by the beginning of next year. It's kind of how I'm looking. There is the prospects, considering the bullishness now, that we can start that intermediate run now that might last a few weeks. But I lean more towards we'll probably get some more weakness now to kind of offset this extreme bullish sentiment we have. Then we'll have a better base to be able to build more than just a 4-week intermediate run, more like a 12 to 16 week intermediate run going through to start us off in 2021. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below what you're thinking and why and what you're looking at. Especially if you disagree, what do you see? What charts or indicators are you looking at that would suggest either that you're a lot more bullish than I am, why you are, or why you're a lot more bearish than I am? Going into today, the big move has been small cap stocks, especially off that October 30th low point. That's been the big move to the upside. They've been leading the way higher, and now you can see the weakness that we got today, that we started to roll over. All these equity asset classes, including real estate, really started to roll over. So if I just look at just how we performed here today, not in 2021, right there, and then just look at it today, then you can see, by the end of the day, small cap stocks had the biggest loss after they started off relatively strong at the peak here before things really started to hit the fan. They had really strong gains, and you can see commodities did pretty well, and commodities ended up holding well. But during this weakness, bonds went from a loss to a gain, the biggest gain of the day, and stocks went from some of the bigger gains of the day to a big drop. You can see emerging market stocks and developed market stocks actually held up pretty well. They had, on a relative basis, and you can also see too, after starting the day with the biggest loss early on in the session, the Qs ended up with the better performance by the time all was said and done, by having a smaller loss compared to SPY. And if you recall, going back to that June 8th peak, from June the 9th going forward, here, let's see, how far do we want to go forward? So June the 9th to about the 26th is when we kind of hit that low point. So after the period where small cap stocks really kicked butt in June, you can see that the Qs ended up holding up better. They outperformed while small cap stocks rallied. So if I were to look at this chart here, this chart right here, this is the Qs on a weekly chart. And if I were to go back to, here's the June, that's when we peaked, and small cap stocks did really well from June. And then going to the end of the month, you can see the initial bounce here by the end of this week. The initial bounce, we bounced right back up to above the 50-day moving average on the relative strength line of the Qs to small caps. That initial bounce, all these stocks fell during that run, right? So everything fell there. The Qs held up, but everything else fell down. So as bearish as we've been here on this relative strength line to get this time below the 200-day moving average, though we are at a higher level than we were before when we peaked last time in June. This if we were to bounce up, which I expect that we will, if we were to bounce back above the 200-day and back above the 50, it will be most likely as we're seeing right now with today's move. Let's do. It will be here. A move where small cap stocks and stocks fall more and the Qs hold up better because they've been lagging so much. Like I said, since that October low point, they've been lagging behind. So, that's an impact on what's going on here. And if you take a look, the other kind of significant impact here lately continues to be the story of these long-term yields. Yes, we have light pink shading, but we don't have a red line. We still have a green line. We don't even have a yellow line. We've got a little bit of a short-term decline, near-term decline, and today bouncing up as of right now. So we'll see if we are eventually to break above that 1% level and start again to continue to really to push up this yield spread up towards that 250 basis points, which is where you'll start to get some inklings of the Fed starting to raise interest rates, right? I mean, there's nothing coming in anytime soon, and for some odd reason it's not filling in here. There we go. But as this continues to break that 1% and we work back up into this area, that will bring the yield curve up into this spot too. And then that's probably where the bullish run will end for equity, for risk appetite as a whole, kind of similar to what we saw over here. Whereas in the early part of 2007, we still had a bullish run all the way up to October 2007, which is actually right there. Kind of very similar to where we're at here, but then we continued higher even through the downward move in equities. We continued higher up to this basis point. The difference is the Fed cut rates during like this period and this period. The Fed's already cut rates, so now you have a rise in the yield spread similar to some of these moves where it had to do with low rates and a rise in the 10-year yield, and that's the kind of move I'm expecting us to see here. The other big influence on the markets here besides rates is the dollar, and you can see the euro had been rising, which means the dollar's been falling, and I expect that will continue to be the trend. But it's been unable to kind of break through back out of this retracement zone here during this little period of weakness. We've been unable to really break out and get going again, so we're still stuck sideways. And like the stock market, we're kind of at the top end of the range and looking like we might be rolling over towards the bottom end of the range. Same thing on the S&P 500 with some strength in the dollar here. So I expect until we break out above that 78% level, it's going to be hard for risk appetite as a whole to follow through and break out with it, including stocks and commodities and other things. Of course, the biggest commodity that we're paying the closest attention to is crude oil, and we see that the big move here for crude oil will be to break up above. If I were to just go to like a 6-month chart, break up above that high point right there and get going again. Otherwise, itself would also be breaking down with these long upper shadows, breaking back down towards this 35 level, which is the lower end of the range that it's been in this time over this period of time. All right, so similar to what we saw in the asset class, the sectors, you can see at the beginning of the day, technology was down early, communication services were down early, discretionary held up, and discretionary ended up holding up most of the day. But then by the middle of the day here, by the time the European session ended, energy was the strongest sector, industrials and financials and materials. Your top 4 sectors, that's been the strength here lately. But then we got the drop, and look at energy dropping like a rock. Utilities and real estate, which led that early October move higher, they dropped too, along with consumer staples. You can see industrials, materials, and financials also dropping to the point where they almost lost all of their gains, relative gains, compared to technology and communication services. So again, it kind of shows you if we're going to have some weakness, where that weakness will be. And as long as utilities isn't like really outperforming to the upside, then we don't really have a kind of this risk off, everybody's worried about the markets. It's more of we got really too bullish in these really small sectors, and if we're going to be bullish as a market as a whole, it can't be these little small sectors that lead the way higher. It's got to, and not until there's more parity from a sector weighting standpoint. At that point, yeah, they can lead us higher. But right now, there isn't very much parity from a sector weighting standpoint. We're very heavily dominated by these 3 sectors: technology, communication services, and discretionary. So if we're going to be bullish, we want those stocks to be the leaders, and that has not been the case. Again, coming off of that October 30th low point going forward, you can see they've been laggards behind All three of them have been lagging the market and dragging it down. And so you have some outsized gains in these small sectors. I expect that they'll pull back during any bout of weakness we get here, and then we'll get those stronger sectors leading the way higher that we expect should lead the way higher. In fact, they did lead the way higher during this initial move, right? This move here. And in fact, I showed you on Twitter, if you follow me on Twitter, this chart that I shared on Twitter earlier today, that first move here from late July up to that September peak, that was heavy into the NASDAQ. So it'd be right about late July, so right in this area here on the S&P 500 all the way up. So probably about the July 24th up to the September 2nd. If I were to take a look at, what led us up higher there, so July, so let's say now the next day after the 24th up to that September 2nd time frame. Technology, discretionary communications or discretionary communication services all led that move higher. So you didn't get a whole lot of stocks getting above the 200-day moving average. But then you did the second go around. That was led by real estate, utilities, and financials. Not your most bullish, leadership there. And then this one, you can see the green line really took off. So a big portion of stocks above the 200-day moving average, up to the highest level we've had in the last 5 years. And we had a pretty decent sized move on the stock market too, very similar to here. But you can see it was led higher by those small sectors. We saw that in June here, and this is what happened afterwards. And you would expect something like that to happen after this too, so that we can get the right leadership leading us up higher. That's a lot more sustained and less extreme. All right, so as you saw, even before the weakness at the end of the day, consumer discretion was outperforming the other cyclical areas and then held up really well. And that brings me to a stock like Target, which broke out today after its earnings. It pulled back at the end of the day like everything else did, but still held the breakout. And you can see its intermediate line. You got dark green shading in the green line. The intermediate line is close to crossing back up above its market sentiment line. Obviously, would have 3 green arrows here with a relative spike in volume here today coming off of that earnings report. Even with the late rally, we are still easily above the 8-day moving average, but not very far off to 30. And that's a good thing in this case for the trade that we're going to do, and I'll talk about that. The histogram taking off, the MACD rising, stochastics above its moving average. Lots of other oscillators here showing bullish patterns. RSI getting above 60 or easily above 100 on the CCI. The DMI showing a breakout directional trade here with the positive well above 30, the negative easily below 20, so the ADX is going to start rising. You can also see from an Ichimoku cloud perspective, we're above a moderately strong trend again. That's probably all we'll get. We don't usually follow big strong trends with another big strong trend. More of a kind of a lesser trend, a weaker trend usually come without a strong bearish move to go in between. You'd end up getting a weaker trend because we were so strong there. But that's okay if we take a look at what we want to do here, and you'll see that what we're going to do is we're going to sell that 165 put and buy the 160 for protection. So when we sold the 165, we were actually right near that 37 or 30. We're actually closer to 35 delta, and so we pulled back. After we put on the trade, the stock continued to pull back a little bit more. That's where it pulled back after we got into it. But again, as long as it stays above 165, and there's a good chance that we can go to 165, and I'm willing to lose $426 on this for $1,000 of risk. So I can let it come all the way down to right about this 160 area now, and you can see that's above the cloud. So it will have some pretty decent support there, as well as support from that 30-day moving average that I mentioned to you before. So it's okay to pull back as long as it holds these levels and bounces off of that. And that's kind of what we'll be looking for if this weakness at the end of the day continues into anything more than that. But as I said before, this stock has been, this stock in particular, and the sector has been, from a cyclical standpoint, has been a relative outperformer compared to the technology and the communication services, where those sectors are more filled with stocks that don't have very good margins of safeties that can fall more on any kind of weakness, as we've been talking about for the last few weeks here. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads there with any questions or comments you have. Reply to anybody else's thread. And let's keep these conversations going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook too. And then comment on the video. Have a great rest of your Wednesday night, everybody. And we'll see you all next time.